Forex Focus brought to you by IG, taking a look today at whether or not the US dollar's golden era is over, as it's been a quite unprecedented run the last couple of years for US dollar. That run is reaching a little bit of an inflection point here, as me and a number of Forex traders, I'm sure, wondering if the US dollar new normal that we've had the last couple of years, right? Near parity or through parity with the euro, getting down close to parity with the pound, 150 dollar yen prices that we've only seen a couple of times going back the last 30 years. This unprecedented US dollar strength that we haven't seen in at least, a decade, in some cases, multiple decades. Could it be coming to an end? Is this the final run that we've had recently? We're going to dissect it all, but first I want to look at the recent activity, what could be calling for this end. And you see this euro getting back above 110. Now, this is a price that euro has traded a couple of times this year, but hasn't been able to stay above that level for more than a few weeks. Getting back there here recently, and will really be a telltale sign to see if more dollar weakness is coming, if that euro can stay above 110, first of all, but extend through it, as it's only been able to get back to 111 back in the April, May area, and then 112 in the July area there, and both times only staying there for a couple of days or a couple of weeks before reverting back below 110. This might not seem like a lot when you look historically at this pair. You'd say, well, Frank, euro is trading above 110 versus the dollar a lot of the time over the last 30 years. And that's absolutely true. But recently, it has not been trading above that 110 level. You'll remember that the euro got down below parity last year for the first time since 2002. So in more than 20 years, seeing the greatest dollar strength that we've seen just last year. And this year, the dollar has fallen a little bit. I mean, it's hard to extend further on 20-year highs for that dollar against euro, and against yen, it was 30-year highs. But it hasn't reverted that much. And that's where the conversation becomes, are we moving away from here the kind of chop that we've seen around historically high levels for dollar? Are we moving away from that and back to a reversion for that US dollar into the 120 to 130 range for euro, or into the 130 to 150 range for pound, as this dollar is still very close to its historically high levels. And so to answer that question, I have to dissect further how the dollar got here, because no coincidence, obviously, that U.S. interest rates in the last year or two have moved to highs unseen since about 20 years ago. Again, no coincidence there, as demand for currency can move higher a lot of times with interest rate differentials between two currencies. And so the US rising to 4%, 5% interest rates near those highs here, looking at the 10-year yield as a common benchmark, that we haven't seen for US rates since the early aughts, translating to a lot of dollar strength. Now, what's been happening in the last couple of weeks here? Well, rates have tumbled actually pretty far, pretty quickly. You look at the highs there in October, the 10-year getting up to that 5% level, very close to highs for the last 20 years. And in the last month or so of action, off about 70 basis points, close to 4.25%. The closest that they've been to 4% here for U.S. 10-year yields since September, and quickly approaching that 4% level that they haven't been at since the summer of this year. And you'll remember that was also the same time that Euro got above that 110 and was extending towards 112. And a lot of people were thinking, oh, here comes that big reversion to the mean in these forex pairs and this reversal lower for US dollar before yields turned back up to 5%. And so in a similar situation whereby US rates are falling, can they fall all the way to 4% or even lower? And how much can that dollar fall with it as we bring back this long-term euro dollar chart? And you can see that the long-term average is close to about $1.25, and we're still right there trading around 110. And, a similar relationship in pound, obviously, but even more drastic for your yen, your Australian dollar. Some of these forex pairs in particular that got that the dollar saw such great appreciation in the 2021, 2022 range, they have a lot more that they could mean revert over the course of the coming weeks and months if the global interest rate environment continues moving in the current path, which is U.S. rates going from the highest of the major economy interest rates back to middle of the pack. Right now, the Fed still has the U.S. overnight interest rate, which is the only rate that they can change. They can't change that 10-year or the 2-year or the 30-year Treasury yield. But those markets a lot of times will move in certain directions before the Fed does have a meeting and move. And those markets moving closer to 4% could tell you that the market thinks the Fed will move its interest rate away from 5.5%, which is, like I say, the highest of these global major economies. And all else equal, that would move us into the Switzerland, Australia, below Euro area, Canada and UK territory, which could mean some pretty violent mean reversion in those forex pairs. Because like I say, pound, it's off its lows, but it's still closer to its lows than it is its highs for the last handful of years. Similar story for Canadian dollar, euro, and especially that Australian dollar and Japanese yen. And so that's what you would think could result in some mean reversion for the US dollar, like I say, all else equal. And yeah, it'd be a matter of here, especially looking at this, this is the dollar versus the yen. Yes, it's fallen this month. This is the monthly chart going back to the early 90s. Yes, it's fallen here in November, but very quickly, a handful of basis points in U.S. interest rates could translate to thousands of pips as this market has moved from the historical high above 150. And when I say historical high, I'm talking, look at this chart for the last 30 years, very few occurrences above that 150 like we've seen in recent weeks and months. But it's only back to about 147, so off around 300 pips from the high. The long-term average in this market is closer to 110, 120, the equivalent of 2,000 to 3,000 pips lower if we do see a flattening of that global yield curve, because obviously you'd expect some historical appreciation in dollar versus the yen, given that the US has gone from 0% rates above 5% rates, and Japan has gone from 0% rates to 0% rates. And so if US comes all the way back down to 0% rates, man, you could see some large scale mean reversion in a Forex pair like that. Now, here is the bull case for dollars, or at least the anti-bear case for dollars, is we could be in a new normal where US rates are the highest globally if each of these economies, the US, UK, Canada, Euro area, Australia, Switzerland, Japan, if everybody moves interest rates lower by the same amount, then theoretically you would expect that Forex markets don't shift so much. There wouldn't be more demand for one versus the other if they're all proportionately moving lower. That's not what markets have been pricing in recently, as US rates have shown the greatest elasticity to the upside and are starting to show some of the greatest elasticity to the downside. Only time will tell. But yeah, looking more and more like the golden era for US dollars could be over.